If you are watching ServiceNow stock right now, there is one question that stands out above everything else. Can ServiceNow really climb from around $125 to $248? That would represent almost a 100% upside from the current price. At first glance, that target may look extremely aggressive, especially because ServiceNow has been hit by fears surrounding the so-called SaaSocalypse and the possibility that artificial intelligence could disrupt traditional software companies. But when we look deeper into the fundamentals, the picture becomes much more interesting. ServiceNow is still growing at more than 20%. Enterprise demand remains strong, its AI business is expanding rapidly, and free cash flow remains powerful. So today, we're going to break down the revenue growth, profitability, AI opportunity, valuation, risks, analyst targets, technical levels, and finally determine whether $248 is realistic or simply an overly optimistic Wall Street target. ServiceNow, trading under the ticker symbol NOW, is one of the world's most important enterprise software companies. The company provides a platform that helps large organizations manage IT operations, customer service, human resources, security, workflows, and increasingly, artificial intelligence. The stock is currently around $124.88, with a market capitalization of roughly $129 billion based on the figures. What makes the current situation interesting is that the stock has fallen dramatically from its previous highs, while the underlying business continues to produce strong growth. This creates a major debate for investors. Is this a fundamentally damaged software company, or is this a high-quality growth company temporarily being valued at a discount? Let's start with revenue because this is one of the strongest parts of the ServiceNow story. In the second quarter of 2026, ServiceNow reported approximately $3.99 billion in total revenue, representing roughly 24% year-over-year growth. Subscription revenue was approximately $3.88 billion, also growing around 24%. This is extremely important because ServiceNow isn't a slow-growing, mature software company. It is still producing growth in the 20% range at a massive scale. For a company with more than $13 billion in annual revenue, maintaining growth above 20% is a significant achievement. And if ServiceNow can continue growing at this pace, while expanding margins and free cash flow, the current valuation could eventually look much more attractive. ServiceNow's subscription business is particularly important because recurring subscription revenue creates predictable cash flow and strong visibility into future revenue. The company's subscription revenue growth remains above 20%, which suggests that enterprise customers are still spending heavily on the ServiceNow platform. This is one of the reasons I don't believe the current SaaSocalypse fears have fundamentally broken the business. If AI were already destroying ServiceNow's core business, we would expect subscription growth and customer spending to deteriorate much more significantly. Instead, the company is still expanding at a very strong rate. One of the most important numbers investors should watch is remaining performance obligations, or RPO. ServiceNow ended the quarter with approximately $29 billion of total RPO, while current RPO was around $13.2 billion, with both growing approximately 21% year over year. Why does this matter? RPO represents contracted business that ServiceNow expects to recognize as revenue in the future. In other words, customers have already committed significant amounts of money to the platform. This gives ServiceNow substantial revenue visibility. A 20% plus RPO growth rate is another indication that enterprise demand remains healthy. Another extremely encouraging signal is ServiceNow's large enterprise customer growth. During the quarter, the company generated 123 net new transactions with more than $1 million in annual contract value, representing approximately 40% year-over-year growth. ServiceNow also had around 658 customers spending more than $5 million, an increase of roughly 23%. These numbers tell us something important. Large corporations are not abandoning ServiceNow. In fact, many of them are expanding their relationship with the platform. This is critical because ServiceNow's competitive advantage comes partly from becoming deeply embedded into an organization's workflows. Now let's get to the biggest reason why ServiceNow could potentially reach $200 or even $248. That reason is artificial intelligence. The market initially viewed AI as a threat to SaaS companies. The argument was simple. If AI agents can perform tasks that previously required dozens of software applications, why would companies continue paying for traditional SaaS platforms? But ServiceNow is attempting to position itself on the opposite side of that trend. Instead of allowing AI agents to replace the platform, ServiceNow wants to become the platform through which enterprises deploy, govern, secure, and manage those AI agents. ServiceNow has reported that its AI business surpassed $1 billion in annual contract value, while deployments of its agentic AI capabilities have grown dramatically. This could become one of the most important growth engines for the company over the next several years. Imagine an enterprise using AI agents across IT support, cybersecurity, HR, customer service, and internal operations. Those AI agents still need access to company data, workflows, permissions, governance, security, and approvals. ServiceNow is trying to provide that infrastructure. If it succeeds, AI could actually increase the amount of software that large enterprises purchase from ServiceNow rather than reduce it. The say-so-calypso argument is not completely dead. Microsoft, Salesforce, Atlassian, ServiceNow, and other software companies still face a long-term threat from AI-native competitors. But the latest ServiceNow performance provides evidence that the disruption may not be as immediate or as severe as some investors feared. Enterprise software is not simply about having a chatbot. Large companies need security, compliance, governance, integration, workflow management, and auditability. These requirements create significant barriers to replacing an established enterprise platform overnight. That's why ServiceNow may have a stronger moat than many smaller SaaS companies. Now let's talk about cash flow. ServiceNow generated approximately $634 million of free cash flow in the second quarter, while first half free cash flow was around $2.3 billion. Management is targeting approximately a 35% free cash flow margin for 2026. If ServiceNow can generate roughly $5.5 billion to $5.7 billion of free cash flow annually, that would represent extremely strong cash generation relative to the company's current market capitalization. This is one of the biggest reasons I believe the stock's current valuation deserves a closer look, instead of simply being dismissed as an expensive software stock. However, we cannot look only at free cash flow and non-GAAP earnings. There is a significant difference between ServiceNow's GAAP and adjusted profitability. In the second quarter, GAAP operating margin was only around 4%, while non-GAAP operating margin was approximately 29.5%. For the full year, management expects GAAP operating margin around 10%, compared with approximately 31.5% on a non-GAAP basis. That's a very large difference. Investors need to understand why adjusted earnings look much stronger than GAAP earnings before assigning a very high valuation multiple to the company. One of the biggest issues is stock-based compensation. ServiceNow has historically used substantial stock compensation, and this creates dilution for shareholders. Stock-based compensation is a real economic cost, even though it is excluded from many non-GAAP profitability calculations. Therefore, I would not value ServiceNow purely based on adjusted EPS. A better analysis should combine revenue growth, free cash flow, diluted share count, GAAP earnings, and long-term margin expansion. If ServiceNow can reduce the gap between GAAP and adjusted profitability over time, that would significantly strengthen the long-term investment thesis. Now let's talk about valuation. Based on the estimates shown in the market data, ServiceNow could generate roughly $16.2 billion of revenue in 2026 and approximately $19.3 billion in 2027. If 2026 EPS is around $4.07 and the stock is trading near $125, the forward valuation based on that estimate is roughly 30 times earnings. Using the 2027 EPS estimate of approximately $5.01, the valuation falls closer to 25 times forward earnings. That isn't cheap, but considering that ServiceNow is still growing revenue above 20%, it is much more reasonable than the headline trailing P/E of more than 70 times. This is where things become much more difficult. If ServiceNow reaches $248, the market capitalization would be roughly $250 billion or more, depending on the future share count. Using a 2026 EPS estimate around $4.07, $248 would represent a PE of more than 60 times. Even using the 2027 EPS estimate of around $5.01, the valuation would still be close to 50 times earnings. That means the company cannot simply grow normally and automatically reach $248. The business would need strong earnings growth, and investors would need to give ServiceNow a premium valuation multiple again. For ServiceNow to reach $248, I would want to see several things happen. First, subscription revenue needs to remain above 20% growth. Second, RPO growth needs to remain strong. Third, AI contract value needs to accelerate significantly beyond the current $1 billion level. Fourth, ServiceNow needs to expand GAAP operating margins. Fifth, free cash flow margins need to remain around or above 35%. And finally, the broader software sector needs to recover from the current valuation pressure. If all of these conditions happen together, then $200 to $248 becomes a legitimate bull case scenario, rather than simply an unrealistic price target. Now let's look at the other side. The biggest risk is AI disruption. ServiceNow is currently trying to benefit from AI, but there is no guarantee that it will remain one of the winners. Microsoft, Salesforce, Google, Amazon, Atlassian, and AI-native companies are all competing for enterprise AI workloads. If AI agents become capable of replacing large portions of traditional workflow software, ServiceNow's competitive moat could weaken. Another risk is valuation compression. Even if the company continues growing, the stock can fall if investors decide that 20% growth is no longer enough to justify a premium software multiple. ServiceNow's acquisition strategy also needs to be watched. The company's acquisition of Armis expands its cybersecurity ambitions, but acquisitions can temporarily pressure margins and free cash flow. Investors should therefore watch whether management can integrate acquisitions successfully while continuing to grow the core ServiceNow platform. The best-case scenario is that these acquisitions create additional cross-selling opportunities and increase the company's total addressable market. The worst-case scenario is that the company spends heavily but fails to generate enough incremental growth. Now let's look at the analyst expectations shown in your screenshot. 43 analysts provide one-year price forecasts with an average target of approximately $140.51, a high estimate of $248, and a low estimate of $72. The important point here is that $248 is not the consensus target. It is the maximum target in that analyst range. The average target of approximately $140.50 is much more conservative. So investors should not interpret the $248 number as Wall Street saying ServiceNow is likely to double. Instead, it represents an aggressive bullish scenario. My own framework would be divided into several scenarios. In a bearish environment, ServiceNow could potentially remain around the $72 to $100 area if AI fears return and software multiples compress further. A more conservative recovery could place the stock around $110 to $130. My base case fundamental recovery zone would be roughly $135 to $160, assuming the company maintains strong growth. A stronger bull case would take the stock toward $170 to $210, assuming AI monetization accelerates and valuation multiples recover. And then we have the extreme bull case of $220 to $248, which requires strong execution, significant AI growth, margin expansion, and substantial multiple expansion. Interestingly, your chart shows a major area around $135 to $140, and this lines up almost perfectly with the analyst average price target of approximately $140.51. that makes this level particularly important. If ServiceNow can reclaim and hold the $135 to $140 region, the market could begin viewing the current decline as a long-term bottoming process rather than a permanent change in trend. Above that, the $160 to $180 area becomes increasingly important. A sustained move above $180 could potentially open the door toward $200 and eventually the extreme $248 scenario. So, can ServiceNow reach $248? Yes, it is fundamentally possible, but I would not treat $248 as the base case. At approximately $125, ServiceNow has several attractive characteristics, including more than 20% revenue growth, strong subscription revenue, approximately $29 billion of RPO, rapidly growing enterprise contracts, a rapidly expanding AI business, and strong free cash flow. Those are high-quality fundamentals, but $248 requires much more than simply maintaining the current business. The company needs to prove that AI is a major revenue accelerator, not a long-term threat. It needs to expand GAAP profitability, manage stock-based compensation, maintain strong free cash flow, and convince investors that ServiceNow deserves a premium valuation multiple again. If I were building a long-term ServiceNow bull thesis, I would focus on three major price zones. First, $140 to $160. This is the initial fundamental recovery zone and is close to the current analyst consensus. Second, $180 to $200. This would represent a much stronger bullish recovery and would require continued earnings and AI momentum. And finally, $220 to $248. This is the extreme bull case, where ServiceNow successfully monetizes AI at scale and the market once again gives the company a premium growth valuation. Ultimately, ServiceNow is not a simple turnaround stock. It is still a high-quality enterprise software company facing a major transition in the technology industry. The biggest question is whether AI will destroy the traditional SaaS business model or create a new generation of demand for enterprise workflow platforms. So far, ServiceNow's revenue growth, RPO, large enterprise contracts, AI business, and cash flow suggest that the company is adapting rather than collapsing. At around $125, I think the risk-reward profile is significantly more interesting than it was when the stock traded at much higher valuations. But investors should not blindly chase the $248 target. My fundamental framework would put $140 to $160 in the realistic recovery zone, $170 to $200 in the bullish zone, and $220 to $248 in the extreme bull case zone. And that's the key takeaway. $248 is not impossible, but ServiceNow has to earn that valuation through sustained AI growth, strong revenue growth, improving profitability, and expanding free cash flow. If those four things happen, $248 could eventually become achievable. If they don't, the stock could remain stuck well below that level, despite having a strong underlying business. This video is for educational purposes only and is not financial advice. Always do your own research before making investment decisions.